Hey guys, welcome to the Personal Finance Bootcamp. I'm super excited that you're here because what you're going to learn today and in the next 4 modules is going to be life-changing. You're going to learn the basic principles of finance, how money works, and how to invest. But first, I want to send you over to my personal finance blog to learn some more in addition to what you learn here. It's checksinthecity.com. So check it out and also join the email list because we have some cool things coming up and you don't want to miss them. But back to the Personal Finance Bootcamp. This is going to be 5 weeks of just really detailed principles of learning how to get out of debt, build wealth, and become financially independent. And that starts with basic definitions. And that's what today's course is on. It's basically understanding the basic definitions of financial terms that we're going to talk about in the future courses. So consider this kind of like a vocabulary lesson. Today you're going to learn 5 basic things. What is a stock? What is a bond? What is a mutual fund? What is a 401k? And what is an IRA? Now, obviously, those aren't the only principles that you'll need to know, but those are the most important ones when it comes to personal finance and this Personal Finance Bootcamp in more particular. So I'm going to go over them somewhat briefly, but I'm going to make it simple for you because it's important that it's simplified. A lot of times financial planners, they try to put it in more difficult terms and then you're afraid to ask questions because you don't want to look dumb. But I want to let you know there are no dumb questions here. Okay. A lot of us start out with a completely clean slate and don't know anything about finance unless we majored in finance or accounting or got our MBA or anything like that. So I want you to feel very comfortable with posting comments and questions in the comments, and don't feel stupid because this is something new to a lot of people and it's something very important to your life. So let's start, shall we? What is a stock? A stock is a share of ownership in a company. So that means when you buy a stock, you're actually buying ownership of that company. So if I buy 1 share of Apple and they've issued 1 million shares, I technically own 1/1,000,000th of Apple. Now, a bond is actually the opposite. So this is question number 2 that we're answering. What is a bond? A bond is actually a loan. So when you buy a bond, you're giving a loan to an entity. It's either a company or the government. And since it's a loan, you as a lender, you get interest, and that's what we call dividends. So when you buy a bond, you're giving a loan and you're receiving interest, which is called dividends. Now, some bonds, just as any loan, are more or less risky based on the riskiness of the entity. That means something like a government bond is probably safer because the likelihood that the government is going to go out of business is a lot lower than maybe a startup business or any company, really. So what does that entail in terms of for your interest or your dividends? Less dividends when it's a bond, say for the government. So a government bond would give you less interest or less dividends. A more risky bond, such as in a company that's just started, is probably going to give you higher dividends, but it's also more risky. Question number 3, what is a mutual fund? Now that we understand what stocks and bonds are, a mutual fund is a professionally invested vehicle that's made up of a group of securities like stocks and bonds. So I want you to imagine a pool that has a bunch of different stocks and bonds in it, and it's professionally managed. So as things are going up, things are getting sold. As things are going down, things are being bought. And it's a constant balancing act. But guess who's doing it? Experts whose day job it is to watch and analyze and use technology to do all of those things. And I emphasize those points because when people decide that they want to invest in stocks, a lot of times mutual funds are the safest bet because if you don't have the time or the resources or the knowledge to be looking at individual stocks go up and down and understanding when you should sell and when you should buy and when you should short and things like that, mutual funds are a good other option. Remember, the number 1 rule in investing is diversification. And mutual funds let you do just that. So imagine I have a pool. It has Amazon, it has GE, it has Disney, it has maybe some newer companies we haven't heard of, some pharmaceutical companies, some banking companies, things like that, bonds. So let's say it has 50 stocks and 50 bonds. When I buy one share of that mutual fund, I'm buying a share of all those companies and all those bonds put together. That being said, if you have a stock in your mutual fund that happens to go down, it's not necessarily a cause for disappointment, because that means that you're able to buy more of that particular stock within your mutual fund. What do I mean by that? Imagine that you own Amazon imagine that Amazon is within your mutual fund, and let's say it's selling for $100 a share. Now, with $500, you're able to buy five shares at $100 a piece. Now, if it goes down to $50 a share, you're now able to buy 10 shares of Amazon. And as we know, Amazon's a pretty good company, pretty strong company. So when it goes back up, you'll now own 10 shares instead of the 5. It's important to note that there are so many mutual funds out there that some of them are good and some of them are bad. That comes from being managed properly versus being managed poorly. So if you're searching for a mutual fund, it's really important to look at a track record. You want one that has at least 5 to 10 years of a track record. And also to remember that a mutual fund is not meant to be traded like the day trading. It's not the type of thing that you buy one day and sell the next. This is for long-term savings and investing. And when I say long-term, I don't necessarily mean that you have to keep it for 30 years until retirement. I just mean that you have to have a window, at least 5 to 10 years usually suggested, depending on the mutual fund that you decide on. Now, let's talk about 401k. And there's a reason why I decided to tackle what a 401k is right after talking about mutual funds. A 401k, well, at least the traditional 401k, is a retirement savings plan that's usually sponsored, or actually always sponsored, by an employer, and it lets you invest your money right out of your paycheck before taxes are taken out. That being said, taxes will be taken out later on when you retire and when you take out the money. Now, why did I want to talk about mutual funds right before this? Because most employers give you a certain number of options within your 401k that you can invest in, and almost always it is the equivalent of mutual funds. For example, you might see something called a growth fund or an income fund or things like that. And what those are basically, they are mutual funds that are consisted of different categories of stocks and or bonds within that category. The most basic kind that I've seen in 401ks or TSP plans, which TSP plans are the government version, or for employees that work for the government version of 401ks, is basically a target date fund, which tends to have the date of your targeted retirement in the fund. And so what it is a mixture of stocks and bonds and other investment vehicles that are based on the level of risk you can take, which is usually based on how soon you're going to retire. So if you're young, if you're in your 20s and your target date isn't until, let's say, 40 years from now, you're likely going to have a lot more stocks within your mutual funds because they tend to be riskier. But if you're within 5 to 10 years of retirement, you're going to see a larger percentage of bonds because, as I stated before, bonds are generally safer, and dividends for income purposes are, usually something needed when you're getting near retirement. Now, a lot of employees offer some sort of matching, which means they actually give you up to a certain percentage the amount of money that you put in. So if you put in, let's say, 2% of your income every year, a lot of employers will actually match that amount. And you know what that means? That's free money. So it's always recommended that if you have a 401k at work and there's any sort of matching, that you contribute at least up to the max. Now, another thing is what to look at when you're in your 401k statements, you really need to look at the performance of the different funds over an extended period of time and compare those to the fund that you're in. A lot of times, the default fund that your employer gives you is the lowest performing because they want to give you something that is safer. But I've seen instances where someone is in the default fund, which is only giving them 2% per year return, whereas every other fund is at least triple that. So you really want to set yourself up in the proper fund. So now let's talk about the final question, which is my favorite. What is an IRA? An IRA is an individual retirement account. Now, these are different than 401ks because they are not employer sponsored, and you can basically do them on your own. There are two types. One is traditional and one is Roth. Now, the traditional is, as I said, not employer sponsored, but you do contribute tax deductible contributions. Whereas in a Roth IRA, you are contributing your post-tax dollars, meaning dollars that have already been taxed. They're not tax deductible, but you don't pay any taxes when you withdraw the money in a Roth IRA. In a traditional IRA, because your contributions are tax deductible, you're going to pay taxes on your withdrawals when you take it out. Now, there is certain minimum age requirements. In a traditional Roth IRA, you can't start taking money out until you're 59 and a half. And all the money has to be taken out by the time you're 70, or else you will pay a 10% tax penalty. And that's a tax penalty in addition to the taxes that you pay in general on the withdrawals. So it's best not to touch this money until you are age of retirement or 59 and a half, as the accounts require. Now, it's important to note that when you set up an IRA, there's a lot of options to choose from depending on what bank you decide to open an IRA with. You can buy individual stocks in your IRA, but as I suggested, you might want to listen to the mutual fund section again, unless you want to just play around with some of your money and you have money to lose, which I don't suggest. I suggest focusing mostly on mutual funds, maybe between 4 and 6 mutual funds that have a good track record over an extended period of time. The other important distinction between 401k and IRA is the contribution limit. The 401k is a lot higher. In 2016, it was $18,000 you could contribute. And for IRAs, between both traditional and Roth, it was only $5,500, as I stated. And that's between the two of them total. So I hope this helped you grasp some of the basic definitions that we're going to use in future parts of this boot camp. What is a stock? What is a bond? What is a mutual fund? What's a 401k? What's an IRA, Roth versus traditional, etc. These are going to come in handy later. And of course, you're going to learn more tips, tricks, and definitions in the future. But these are the ones that I wanted to start out with, give you a little bit of at a time. I also encourage you to check out checksinthecity.com, as you will get some really cool personal finance tips and you could win some cool prizes, as I said. I want to thank you so much for joining me and see you for part 2 of the Personal Finance Bootcamp.